you ever wondered what the most important macroeconomic indicators are? In today's day and age, we are bombarded every single day with news about what the Federal Reserve is doing, about what the government is doing, geopolitical issues, what the stock market is doing, what other assets like gold or Bitcoin or real estate are doing. It can very easily become information overload. But don't worry, because going into 2024, there are 6 things that everybody should be watching. They are the most important macroeconomic factors that everything else flows from. And if you watch just these 6 things, you'll have a very good idea of how the year will unfold. The first thing to watch is the reverse repurchase facility at the Federal Reserve. This facility currently has just over $1 trillion in it. You can think of this facility as an overflow of excess reserves in the banking system. Back in 2020, when the Fed printed all that money, they printed that money so that it could make its way to the federal government, so the government could spend it on things that they wanted, like stimulus checks. But at the same time, the Federal Reserve was also spending trillions of dollars to buy assets off the market, assets like US Treasuries. This meant that while the government was spending newly created dollars into the banking system, the Federal Reserve was sucking collateral like US Treasuries out of the banking system. For you and I, that might not sound like a big deal, but for banks, it is a big deal. Because for a bank, every dollar they get in deposit, they also have to have some sort of offsetting collateral as an asset to offset that liability. And so banks began to use the reverse repurchase facility at the Federal Reserve that allows them to give the excess cash to the Federal Reserve overnight and get collateral back in return. Without this facility, banks would have had to go to the open market to get that collateral, and rates were already so low, it could have probably put interest rates negative. So the Federal Reserve offered an interest rate to attract cash to come into the reverse repo facility instead. But as you'll notice, since May of 2023, the facility has been getting drained, which means that dollars are choosing to leave the reverse repo facility. They're going somewhere else instead. And that place they're going is United States T-bills, as starting in May of 2023, the rate on T-bills finally exceeded 5.3%, which is the rate the reverse repo facility was paying. So the dollars simply got a better return by getting taken out of the reverse repo facility and getting lent to the US government in short-term T-bills instead. This means that while the reverse repo facility still has cash, the US government can borrow as much as they want with T-bills. Now you may be looking at this chart of the reverse repo facility and thinking, hey, we were already down to 683 billion in there, but now we've skyrocketed back up to 1 trillion. What is going on? Nothing out of the ordinary. This is simply a year-end thing that happens at quarter end and at year end. Take a look at this spike that happened at the end of 2022. Exact same thing, and then it came right back down to normal levels. So within the first couple of weeks of January, we will see the exact same thing happen here. It will start to decline again like it was before. And when the reverse repo facility hits 0, that means there is no more cash left to be taken out by market participants like money market funds to be lent to the US government with T-bills, which means the US government is either going to have to start borrowing at the longer end of the curve, where interest rates are lower, like the 30-year is only at 4%, or the 10-year, which is only at 3.8%. Or if the federal government continues to want to borrow at the short end with T-bills, they're just going to have to offer a higher interest rate in order to attract new cash. Either way, the reverse repo facility hitting 0 means liquidity conditions have changed. It means there's no longer a ton of excess reserves in the system, and the United States government's excess borrowing at the short end, at least, will have to change. Now, the second most important macroeconomic factor to look at for 2024 is the Federal Reserve's balance sheet. We can see the Federal Reserve's balance sheet used to be under $1 trillion, and then to deal with the financial crisis, it exploded to over $2 trillion and then continued to increase to a peak of about $4.5 trillion in 2015 before they started their first round of quantitative tightening. Quantitative tightening is the exact opposite of quantitative easing. QE, quantitative easing, is when the Federal Reserve's balance sheet increases. That means the Fed is printing money in order to buy assets out of the market. So the Fed will go to a bank and they'll say, hey, you have a US Treasury because you loaned money to the government. We want that. We'll buy it from you. Here's some brand new cash, give us that treasury. And then at that point now, the US government owes that money back to the Federal Reserve instead of the bank who initially made the loan. As the Federal Reserve does this, the balance sheet increases in size because they own more assets, just as if your brokerage account were to increase in size as you purchase more assets. The only difference is they print the money to buy those assets. You first have to come up with the money to put into your brokerage account to buy those assets. So when the Federal Reserve's balance sheet declines, the exact opposite is happening. The Federal Reserve is either selling some of those treasuries back out onto the open market, or they're just letting some of those treasuries get paid back and they're not rolling it over, meaning they're not taking that cash and buying a new treasury of the same amount. Now, because they want the decline in their balance sheet to happen at a consistent pace, they're likely doing a combination of both, so that they're doing a little bit of buying, a little bit of selling, a little bit of letting it mature so that the size of their balance sheet overall declines at a consistent pace. The last time they did this was in 2018 and 2019. The market couldn't handle it, so they started not QE in 2019, right before all the money printing in 2020 happened. But as you can see, as of May of 2022, the balance sheet peaked and the balance sheet has been declining ever since. If we zoom in here, we can see the exact same thing is happening now as was happening before, which means quantitative tightening is still continuing. Now remember, during QE, the Federal Reserve takes a newly created dollar, gives it to a bank in exchange for an asset like a US Treasury. That increases liquidity conditions for banks. The banks can take that money and do whatever they want with it. They can do nothing. They can loan it to the US government again. They can make a new loan like a mortgage or an auto loan, but it increases the bank's liquidity and their options on what they can do with it. This means when the Federal Reserve's balance sheet is declining, the exact opposite is happening. Instead of new dollars entering circulation, dollars are actually leaving circulation and ceasing to exist. This is because, again, when the Federal Reserve's balance sheet is declining, that debt is getting paid back. The Federal Reserve doesn't need to collect dollars as payment in order to spend it on something else. When they spend money, they create that money fresh. When money gets paid back to them, it ceases to exist. So when the US government pays back those US Treasuries, those loans that it owes to the Federal Reserve, those dollars leave circulation. And so the longer the Federal Reserve continues quantitative tightening, the less liquid markets become, the less dollars there are available in the financial system. So quantitative tightening, or the total size of the Federal Reserve's balance sheet, is absolutely the second most important thing to watch in 2024, because if this stops, if the pace of QT increases, if the pace of QT decreases, this has big, significant effects on liquidity for banks, which translates into liquidity for things like the stock market and the interest rates on loans for people like us. Not to mention interest rates on loans for the US government themselves. The third most important macroeconomic indicator to look at in 2024 is going to be the total money supply. This is a chart of the money supply going back all the way to the 1980s, and we can see it increased at a fairly consistent pace up until 2020, when it started to skyrocket. Zooming in on the last couple of years, we can see the money supply peaked in April of 2022 and started to decline from there. It bottomed in May of 2023 and has been moving sideways since. And if you're wondering if the money supply is moving back up again, don't worry. This is again just a year-end type of thing that happens. The same thing happened at year-end of 2022 before it continued its decline. Now, the money supply is going to be influenced by the last couple of things that we looked at from the Federal Reserve and some of the other things we're going to look at later on in this video. But the money supply itself has massive implications for everything going on in the economy, from prices of assets like stocks and gold and Bitcoin to the cost of money itself for lending and borrowing. And since the Federal Reserve has been collecting this data, you can see that the money supply has never actually decreased until recently. We can find alternative sources of information that go back farther that show that there have been some times in history when the money supply has declined. This chart from long-term trends shows the money supply growth rate going back all the way to the 1800s. And we can see, based on this measure of the money supply, we have not seen a decrease in the money supply since the 1930s. Based on another measure of the money supply growth and decline rate, we can see every time the money supply declines, it is associated with banking panics, recessions, depressions, and even wars. So the fact that right now we are experiencing a contraction in the money supply for the first time since the Fed has collected the data, and for the first time since the Great Depression, is not an indicator of economic success in the near future. Based on historical patterns, we should expect some economic pain as a result of this. But of course, they could always fire up the money printer again, which would also result in a resurgence in the inflation rate. And so the money supply, which has been declining since April of 2022, is definitely one of the most important macroeconomic factors to be looking at in 2024. The fourth most important macroeconomic factor to look at this year is going to be the federal funds rate. We hear talk all the time about how the Federal Reserve controls interest rates, or they're raising interest rates, or they're lowering interest rates, and how that affects everybody's mortgages and credit cards and auto loans. And the reality is the Federal Reserve does not control any interest rates except its own. And they do this by raising or lowering the federal funds rate. This is the overnight rate that banks trade cash and collateral with each other, and the Federal Reserve simply sets the upper and the lower limit on this rate. If the interest rate that is going between banks starts to exceed what the Federal Reserve wants to be the cap, the Federal Reserve will intervene, and they'll either provide the collateral or the cash necessary in order to keep it underneath the cap. Same thing if the interest rate starts to go below the federal funds target, the Federal Reserve will intervene in order to make sure that that interest rate stays in between their tight range. But this, the federal funds rate, is the only interest rate that the Federal Reserve actually controls. So when you hear about interest rates on mortgages going up or down and you think, hey, I could sell or buy a house, or you hear about auto loan interest rates going up or down, or you hear about credit card rates and how they're currently at a record high for decades. They used to be around 14, 15%, and now they're over 20%. None of these interest rates are actually directly controlled by the Federal Reserve, but the Fed funds rate does have an influence on those interest rates. You may have noticed recently how there are some high yield savings accounts offering 4 or even over 5% interest on savings accounts. This is because banks can get this amount or a little bit more directly from the Federal Reserve, and after taking their cut, they can pass along that interest to you. But if the Fed decides to cut rates, then there won't be anybody out there offering those higher rates, which means banks won't be able to offer that to you. This also has an effect on longer term debt, because in a normal environment, if I can put my money in the bank and I can get that money back at any time, but I can earn 5% on it, well, I'm going to demand a much higher interest rate if I'm going to lock that money up for 5 or 10 or 20 or 30 years. And so while the federal funds rate is the only interest rate that the Federal Reserve directly controls, it is absolutely important that you keep an eye on it because it does have an influence on the rest of the curve. Now, I mentioned there that in normal environments, that longer term debt is going to have a higher interest rate. And if you've been paying attention, you know that's actually not the case right now. Which brings us to the fifth most important macroeconomic indicator to watch for 2024, which is the yield curve itself that is currently inverted. This is what the yield curve looks like as of the time of this recording, and you can see that for short-term government debt, it is yielding well over 5%. This means you can loan money to the government for just a couple of months and get an annualized 5.2 to 5.5%. But if you loan your money to the government for longer, let's say 5 years, you can only get 3.84%. Now, at first glance, this seems preposterous. Why would anybody loan the money to the government for a lower interest rate for a longer period of time? And the answer is because people expect that between now and then, interest rates at the short end are going to go lower. Yes, today you can get 5% by loaning your money to the government for 1 month. But if you think that in 1 year that 5% will go down to 1%, then locking yourself into a 5-year contract at 3 or 4% may actually be the better deal over that 5-year time horizon. And an uninverting of the yield curve like that, where the short end goes down and or the long end goes up, is exactly what investors investors are expecting, which is why the yield curve is so important to watch right now, because it's currently inverted and investors expect it to uninvert. Problem with that is almost always associated with a market crash and or a recession. The inverted yield curve itself has an almost unblemished record of being able to predict a recession coming soon, but it usually starts once or right after that yield curve uninverts. We can actually look at the federal funds rate for examples of this, and you can see the gray bars are all recessions. You can also see that those gray bars all happen right when that interest rate starts to move lower or right after that interest rate starts to move lower. Those are almost all examples of the yield curve uninverting, because the Federal Reserve pushes down on that short end, which then becomes lower than the long end. And so in 2024, it's going to be very important to watch that yield curve and watch for that uninversion. And finally, the sixth most important macroeconomic factor to watch in 2024 is going to be the federal government's deficit, specifically the budget deficit, which as of the time of this recording is currently up 13% higher than the same period last year. The budget deficit is the difference between how much the federal government spends and how much they take in taxes. And I use that word very intentionally because governments can't make money, they can only take money. Now, for pretty much the entire history of the United States, the federal government has run a deficit, which is why the total national debt continues to just grow and grow every year, because just like you, if every year you spent more than you earned in income, you'd have to do that by one thing only, which is debt. So the deficit represents how much the government borrows every year to cover its extra spending, which means that every year that they run a deficit, the national debt increases by that amount. Now, there are a number of reasons why the deficit is important. Number one, an increasing deficit leads to conditions like we have today with interest rates at multi-decade highs. Many people think that if the stock market experiences a correction or a crash, all that money will rush into US government treasuries, which will push interest rates down. That assumes, of course, the government doesn't have an appetite for borrowing larger than the amount of money being willing to lend to them. And all else being equal, the more the US government borrows, the higher those interest rates go. And if you can get, let's say hypothetically 10% by lending money to the US government, you're probably not going to keep that money in the stock market. You're probably not going to lend that out in the form of a mortgage or put it in a CD with a bank. So the more the government borrows, the less money there is available for everybody else to borrow. On top of that, the deficit contributes to the national debt, which by itself isn't a very useful number. But when you look at the national debt compared to something like the GDP, you get a more accurate picture of where our economy stands. Going back all the way to the late 1700s, we can see there's only one time in history where the national debt compared to GDP was as high as it is today. And that was at the peak of World War II. Now, obviously, World War II, when it ended, we ended a ton of spending and a bunch of people came home and started working and producing again. So GDP went up and debt went down relative to all the wealth. But we're back up to 120% debt to GDP levels. And we don't have all of our working force age men overseas fighting in a war somewhere that will just stop one day. We have this debt and we have this deficit and we have this spending because of a massively bloated government. And trying to shut down anything meaningful in terms of spending or borrowing is political suicide, which is why nobody does it. And no, the last administration did not do it either. Go take a look at the national debt and the deficit under the last administration, and all you'll find is broken promises. And so the deficit is absolutely the sixth most important macroeconomic indicator to be watching in 2024 because it contributes to higher rates, crowding out, and a debt load that our economy can eventually not handle. Now, these conditions are very likely to bring in a chaotic year investing. And that doesn't necessarily mean everything going down in price, just a collapse of everything. It means exactly what chaotic means, just highly volatile, unpredictable. I have my thoughts and opinions about which assets will do and which assets will not do well, but that doesn't influence how I position my entire portfolio, and it shouldn't influence how you position your portfolio either. There are three pillars to investing and beating the averages in any market conditions. Number one, you need 8 to 12 assets that are highly uncorrelated, meaning when one goes up, they don't all go up, and when one goes down, they don't all go down. Number two, you need to learn how to hedge, cost effectively, meaning that you purchase fire insurance on your assets so that if they go down in price, your insurance or your hedges pay you off an equal amount. The issue is you have to do it in a cost-effective way so your portfolio doesn't decline simply from buying that hedging over and over again. And then the third pillar of investing successfully, beating the averages in any market, is making many small asymmetric bets, because there will always be opportunities to make massive amounts of money. But if you commit too much of your portfolio to one of those bets and it doesn't pay off, maybe you just lost 5 to 10% of your portfolio. Not good. So you need to learn how to make many small bets that if they pay off big. So it's meaningful to your portfolio. But if you're wrong, you lose a very, very, very tiny amount. If you can master those 3 pillars of investing, you will beat the averages in any market. And if you need help with that, that is exactly what I teach members of Heresy Financial University. So if you're interested, link is in the description below. As always, thanks so much for watching. Have a great day.